Good afternoon, everybody. We're joined now by Adam Collins. Adam is the founder and portfolio manager of Movement Capital, which is an independent investment management and research firm. Adam also maintains three free websites, free data-driven research websites: free COT data, commodity seasonality, and simple stock models. We hear from Adam each week on changes to the latest COT report released from the prior Friday, along with very interesting seasonal trends. Thanks for joining us, Adam. What's going on today?
Yeah, happy to be here. So let's get into it. So first thing, disclaimer, none of this is investment advice. And for any new listeners, when I look at positioning, I'm looking at COT data. And in a nutshell, that just shows how different types of traders are positioned in the futures markets. And the way I look at it is sort of unique. I don't just look at like the net, number of contracts people are long or short. I make a 5-year percentile out of it so I can sort of give context to current positioning. So to this week's data, probably the most interesting thing right off the bat is the fact that over the past couple years, I can't remember a time when there have been this many crowded commodity spec shorts. So in plain English, what this chart shows, this is the 5-year percentile metric I talked about. If it's 0%, like it is right now in platinum, gold, palladium, and coffee, what that means is that speculators haven't been this net short in 5 years in those contracts. And positioning, while not as extreme as like those four, it still is very crowded on the short side in lean hogs, sugar, silver, soybean oil. And then on the flip side, the crowded long trades, there's really only one that's long wheat. But this is sort of the big picture is there's lots of short exposure in commodity futures right now. So getting to the individual contracts. Here's a zoom in on WTI. And this is net spec exposure in dollars. So it's taking the spec position, multiplying it by the contract multiplier in the front month price. So this is where it's getting interesting to me because in WTI, for the longest time, it's been this, crowded trade that people have talked about of, everybody's on one side of the boat, long oil. And that was true all last fall, but what longs had going for them then was a steady uptrend. So it didn't hurt them to sort of maintain that long trade. But now, everybody's seen the price action. It's been more sort of the downside, short term in crude. And what I've talked about in all these webinars is you can't just look at extreme positioning. You have to factor in price action. So it's one thing to have just extreme positioning. And to me, it's not that notable because it's not that rare. But when you have extreme spec positioning and when price action hurts them and is going opposite of how everybody's positioned, that's when you get truly actionable situations that are like the equivalent of, yelling fire in the theater. And so I'm not so close to saying we're there in WTI, but we're a lot closer than we were when we were $70 a barrel. So that's something to watch out for. Here's the number one most crowded commodity spec long. It is Chicago wheat futures. And it's sort of unique because it's sort of the sole agricultural commodity with crowded long spec positioning. The other stuff like corn, soybeans, is not the case. Here's sugar. So this is an example of crowded spec positioning, but to be honest with you, I find it less relevant. And here's why. So traders, the graph on the left, you can see that they're really net short sugar. It's sort of like a near 12-year extreme, but look at the trend in sugar. It's steady downtrend. And so the people who are in that trade, they're not hurting. So to me, I guess it's something to note that, sugar is a crowded short, but it's going their way now. And here's soybean oil. It's similar to sugar, and that's been a steady downtrend, and spec exposure is leaning heavy short. Here is silver positioning. So what I'll talk about in a second that most people are talking about with this week's COT release, which is gold, it can't really be said for silver in that spec positioning, it's definitely, you can't say leaning short because they're still net long. Like look at this graph, they're still net long like a billion of silver futures and options, but it's not as extreme as in the other precious metals like gold, platinum, palladium. RBOB, similar to WTI, of specs leaning long. But I will say in WTI over here, where is it? Oh, I didn't have the 5-year percentile chart. Long story short, hedgers are sort of positioned differently in RBOB and WTI, but specs are sort of the same. Okay, so here's platinum, one of the really crowded commodity shorts. And that's not new, but it doesn't diminish the fact that the position is still quite extreme. Palladium is interesting because, like, look at these two. So platinum sort of had its, it became a crowded spec short a couple of months ago. Palladium's very recent, and palladium flipped a lot quicker, meaning that we went from super crowded long trade to a very crowded short trade in just a few months. And that's sort of rare. Typically, positioning takes some time to fully unwind, but in platinum, it happened very quick, very fast. Here is copper, sort of similar to palladium in that it was a quick spec unwind, but copper definitely came off of a very crowded long level. And I talked about it last week, but it was this horrible setup for, most specs where they got super long, north of 320 and like near 12-year highs in net long positioning. And right after they established that, copper pulled back, 15, 20%. And so that definitely hurt a lot of traders. Here's nat gas. Positioning is honestly not that extreme in Henry Hub, but I think specs are net short like $1 billion. And it's one interesting thing about the nat gas futures market relative to all these others is that when you decompose the open interest into the trader category, as in you identify of these categories who's sort of a big fish, small fish in these markets, speculators are a large slice of the nat gas futures market relative to especially stuff like soft commodities where hedgers dominate. So here's gold. Here's sort of the most headline worthy thing of COT this week. And this is first showing the less frequently talked about, the hedger position. So right now, gold producers and users are in aggregate net short around 5 billion of gold futures and options. And so this number has become less net short over time. And what you can imply from that is that gold miners have become, less willing to sell futures and lock in future prices for their, future production. And then gold users have become more willing to buy gold futures and lock in costs for their future inventory. So, it's not super extreme, but we're definitely getting near levels of where, gold hedgers in aggregate have rarely had this little net short exposure. But here's sort of trader positioning in gold. And so it's really extreme. It's back to the start of the data set for this disaggregated report. This is actually the first week that gold traders have ever been net short. So when people in weeks prior, they've talked about, extreme gold positioning, they were still net long. And so the graph on the left shows the net spec position as a percent of the open interest. The graph on the right just shows it in dollars. And they are net short for the first time since, 2006. And there's different ways to interpret this. Obviously, long gold is a very contrarian position, but in the early 2000s, because I can look back with the older legacy report, speculators were long gold for a long period of time. And so you never, as I guess, smart people say, extreme positions can continue being extreme, and that's very true. And so with gold, what would make this crowded short positioning relevant is if it were to start to technically turn. So today's, a little bit of that. You need a lot more to make it, actionable in my opinion. But gold's definitely a very crowded short trade. Here's corn. Corn sort of like zigzag between these, and this is spec positioning. So it's sort of gone back and forth between, specs being net short, 4 billion and net long 4 billion over the past, 5 years. And like, sure enough, a couple of weeks ago when we hit net long levels of like 5-6 billion, that was sort of a ceiling. And then, corn fell back. Here's copper. And the addition on this is the 5-year percentile. So here's why I showed this graph on the left. You sort of look at that, you're like, oh, wow, specs have really pulled back. But if you sort of zoom out and look at that spec positioning relative to the past 5 years, the graph on the right, you can see that, yeah, copper spec position, it's come back, but it's sort of in the middle of the road. It's not, a super crowded long, it's not a crowded short. And so it's sort of a wash at the moment. So here's coffee is another one of those really crowded short trades, but like sugar, it is a crowded short in a very steady downtrend. And so this doesn't become actionable to me unless coffee actually picks up steam. And what coffee has going against it that's sort of unique to coffee is almost more than any other commodity futures contract, the front portion of the coffee curve is ends very steep contango most of the time. And what that means is, so if you've got, a 5% difference between front month and second month futures, and you're long and you want to maintain that exposure, you got to roll. That's a very hefty bleed to incur to keep that long exposure. And so long coffee, as long as this term structure stays where it is, it's just a tough position to carry. Turning to currencies, so here's the Swiss franc. Swiss franc is it's one of the two most crowded currency trades, and this is crowded on the short side. Traders are very short the franc against the dollar. And what's interesting to me is that they're very short, the franc, and the price action to me, I'm not super technically inclined when it comes to like labeling patterns and such, but like the recent price action almost resembles a coil of you've had this sort of compression of price action. And if you can combine crowded positioning, compressing price action in a move that hurts crowded traders, that's where you get like really insane moves. That was the franc. Here's the New Zealand dollar, which is the other really crowded short. And so traders are net short like 70% of the open interest in Kiwi futures, which is definitely extreme. And the takeaway from both these charts is that the flip side of it is when people are super short, the franc or the New Zealand dollar, they're inherently long the USD. And when you combine that fact with what I talked about, how speculators are very short a lot of commodities, long USD is a very consensus trade, and it's expressed a variety of different ways. And so here's some other currency stuff. So here's euro, and this is interesting to me because WTI right now is almost striking me as how euro did a couple weeks ago, because so both these trades, long WTI, long euro, were sort of these trades that got crowded and stayed crowded last year, and they stayed crowded mainly because the trend kept on going their way. But euro sort of turned before WTI, and euro spec positioning it has not fully unwound. It's no longer super extreme, but you can see in the graph to the right, there's still a lot of net long spec interest. But what I'm getting at is, just as sort of the euro spec long concentration didn't matter until that trend really changed, it's just it reminds me of WTI right now, of if we saw front months WTI, trade sub 65, it wouldn't surprise me if you were to sort of see this like constant selling like we've seen in the euro. So here's the pound, which is positioning's not super extreme, but specs have definitely added to their net short exposure in the pound and in the Aussie dollar. And so for people who are freaking out about China and they say, oh, I want to protect myself, I want to, short some Aussie dollar because I think that would crater if China cratered. If you're going to take that position, you've got to acknowledge the fact that you're not alone. In fact, you're joining the majority of traders who are short Aussie dollar. Here's the VIX. So VIX positioning is interesting to me, really interesting to me right now, actually. So the graph to the right shows the dollar open interest in VIX futures. And so what happened earlier this year in early February is, the XIV ETF terminated. And I think roughly $3 to $4 billion was in that, is actually an ETN, but they had to track it. So the money did hit VIX futures. Long story short is, after that event, I didn't expect to see specs get as net short VIX futures for a long time, because XIV was sort of the main conduit. It was this weird setup of where, the exchange traded product sort of, was the tail wagging the dog for VIX futures. And once XIV terminated and that didn't become accessible, for retail traders to easily put on a short vol position, I was like, oh, this market's probably gonna, probably be more calm and less of a consensus short going forward. But what I did not expect is right now there is more net short spec exposure in VIX futures than there was in January 2018 before the short vol trade blew up. Like, look at this chart. So the short vol trade in VIX futures, at least, there's lots of derivatives of it, but in VIX futures, it sort of hit its peak in early 2016. That's where traders were net short like 2.5 billion. And so if you sort of rewind the clock back to Jan 2018, the positioning wasn't like super extreme. I mean, they were net short like 1 billion, but it wasn't, the 2016 lows. But what's interesting is the positioning now is more extreme than it was in January, and there's not even that conduit for retail to get into it. There are other ETFs like SVXY but there's a lot less AUM in them. And so what this says to me is the people who have re-embraced short vol have been less retail through exchange traded products and more, I don't know, institutional or funds through, direct futures. Here's the S&P positioning. On the left, we've got in dollars. On the right, you got the 5-year. And so on an absolute level, there's a lot of net spec long exposure. They're net long like 50 billion, but it's come off a good bit from the Jan 2018 highs of like net long 115 billion. And I talked about it last week, but it's important to reiterate of the last true sort of like equity vol we had in late 2015, early 2016, that didn't happen with lots of spec long exposure in S&P futures. If you look at the graph on the left, you see that positioning was coming in for months ahead of that pullback. And then, once sort of the August Chinese devaluation happened, spec positioning wasn't that extreme. And so that's sort of a corollary right now is, spec position has pulled back, but I don't view that as an obstacle to further S&P weakness. And this is sort of the big combo chart. This is looking at spec positioning between E-mini S&P, E-mini Nasdaq, and the mini Dow contract. And so the reason why it looks like a lot like the S&P contract is because the Nasdaq and Dow contracts are so small relative to the S&P. Here's Japanese stocks. Positioning has gotten more crowded on the long side. It's not super extreme, but it's sort of been this back and forth of where, fall 2017, most people were long Nikkei, and then it got a pretty crowded short earlier this year, and then now we're back to quite long positioning. Here's an interesting chart. So this is looking at Nasdaq positioning, and it's interesting to me because it's very different than S&P positioning. So over here, we've got the graph on the right for the 5-year percentile, the white line. Specs are long, but not crazily so. But if you look at Nasdaq, if you were to ask somebody without showing them positioning data, if you were to ask them, guess how traders are positioned in Nasdaq futures, I'm pretty confident most people would say they're leaning long just because it's been such a monster trade for eons. And it's not the case. Traders, they're not leaning short, but their long positioning is really low. And this is interesting to me because it says that the Nasdaq has continued to rally despite just like lackluster long interest in futures and options. So here's sort of the overview charts. This is first for commodities, and I started with this. So takeaway from sort of this week is lots of crowded short spec trades in commodity futures, and it's sort of led by precious metals of platinum, gold, palladium. This is the same metric for financial futures. Not as much to write about, so there's not really any crowded longs. And I define crowded as a 5-year percentile, either greater than 90% or less than 10%. But the two crowded shorts, like I mentioned, are the New Zealand dollar and the Swiss franc against the USD. This is hedger positioning in commodities. And so this is sort of the inverse of commodity spec positioning. And you can see where, producers and users of where they're either have very little net short exposure or they're actually net long is in the same stuff in, platinum, coffee, lean hog, sugar. And there's not really any crowded hedger shorts. Wheat sort of on the borderline. And when you look at this, that's implying that a lot of wheat producers are selling wheat futures to lock in, future prices for their future production. So turning quickly to some seasonality stuff. So this is looking at September seasonality. So not August, but September seasonality. So what's worked, what hasn't. So and this is looking at the 20-year average monthly performance for a roll adjusted contract. So on the left, we've got the contracts with the highest average monthly performance. On the right, the lowest. So we've got oats, gold, and the 30-year treasury, the highest average monthly performance in September. On the right, the lowest, we've got corn, platinum, and soybeans. This is looking at the term structure of commodities. And it's interesting to me because for the past 18 months, there have been like a healthy number of commodities in backwardation, meaning that, the front month price was higher than the second month. But this is sort of the first week in a while of where there's not much in backwardation, and there's honestly not that much in contango. It's sort of like flat curves across the board. But obviously, sugar stands out as a commodity in really steep contango, which makes long exposure difficult. And then finally, we've got momentum. So this is looking at 12-month roll-adjusted momentum, just like top performers, bottom performers. Over the past year, wheat and crude heating oil are the top 3 highest momentum contracts, and the bottom 3 are coffee, platinum, and sugar. So that wraps it up. And if you got any questions, I'm happy to answer.
Yeah, that was really fascinating as always. I love looking at some of these charts and seeing things in real time as the markets evolve. It's great to see. Um, I'll go to the questions first. From we have a few questions I'll ask from these guys. How did wheat? I guess somebody's asking, how did wheat not have a drop in sentiment given the recent pullback? It looks like I was just looking at the chart. I think when we were speaking 2 weeks ago, wheat got up to 613 or so in the future, and then actually dropped to 550, which is over a 10% decline. And we have snapped back since, but I guess that's the question on given that decline.
So, very important thing to remember with COT data. So everything I just ran through is positioning data that was released last Friday, and it covered positions up to last Tuesday's close. And so I don't know where wheat was trading last Tuesday, but if wheat fell out Wednesday, Thursday, Friday, then those position changes are not picked up in this data.
It was at least 12% off the high.
Really?
Yeah.
So that's really interesting then. Okay, so then you've got something really interesting of you've got wheat, falling, then you've got specs who have not capitulated, and that to me is that gets to actionable COT setups. People are underpaying.
Yeah, it seemed interesting and surprising. Another question: do you think the COT report will update to be more relevant more real time, opposed to close on Tuesday and release on Friday?
It's been that way for I think decades, and I wouldn't estimate that. I have a feeling the CFTC goes through a lot of record keeping in that interim to sort of verify the trader categories, to reconcile the positions. And so that'd be awesome. And I would happily update all my stuff if that happened, but I wouldn't hold my breath.
Yeah, I guess they have the information pretty close to real time because they have the information when anybody clicks the button. Kind of a idea of who everybody is, and so they can.
But I will say this: so it hasn't always been as of Tuesday released on Friday. In years prior, I think it's been like more than a decade since this. But it used to be just monthly snapshots, and so it's gotten a little bit better.
Yeah, absolutely. Then. So somebody was asking about the VIX because that was very fascinating. The VIX chart, your data, does it include anything other than futures? Because you mentioned ETFs, that's why they're asking.
Yeah. So, and I probably should include this in that sort of like intro slide. All of this data. So there's sort of there's two versions of the COT report. There's sort of the legacy older one, disaggregated newer one. That's more transparent. I use it disaggregated, but there's another two ways you can slice it. You can look at futures only or futures and options. All of my data, all these charts, they're futures plus options. And they convert options positioning on a delta equivalent basis. But in plain English, this is only futures and options. This is not isn't any ETF stuff. And if you want to track ETF positioning, what I would do is I would go to ETF.com. I would search in the most popular VIX products. There's SVXY on the short side, VXX on the long side, and ETF.com shows daily fund flow data. And so you can basically see if people are pouring money in or pulling money out of those VIX products.
Yeah, that's we'll definitely take a look at that. Have you looked at that? Do you know a sneak peek? Does it resemble what you're seeing here in the futures?
No, I haven't looked at it recently.
Gotcha. So I had a question. I'm actually just going down. I have so many questions, but I'll just stick to one or two. It's interesting, actually. The crude seems to be pretty long still, despite a 7 week. We're basically in 7 straight weeks of decline, and your data basically shows a bit of a stubborn long, which is probably a painful stubborn long.
Yeah, I was honestly surprised when I sort of refreshed everything this week because I was expecting the net spec position crude to decrease a pretty good bit, and it did a little bit, but it just didn't as much as I thought. And that says to me that, obviously the data shows a lot of people are still long crude, and if you start to trade 65, 64, 63, it just raises the probability in my mind of a painful exit for them.
Yeah, well, that's what it seems like because they're holding on to it now. They're down money in it, and so there's probably some trigger point at some point where they just puke it out.
Yeah.
Here's a question for you. for the past few weeks, you've been talking about the heavy Swiss short.
Yep.
But at the same time, Swiss as a whole has actually held up better than Euro. So, like for instance, if you take a look at Euro Swiss has gone down, which is selling Euro, buying Swiss.
Mm.
So the data is based off of one contract, dollar Swiss, right? It doesn't incorporate
Correct.
like Euro Swiss or Swiss yen or something like that.
Right now.
Yeah.
And so it's interesting to me in that because basically all this position data, it's based off of listed currency futures, and the major CME contracts are all like dollar pairs. They do have some like euro yen stuff like that pairs, but there's like nobody trades those futures, and so it's irrelevant. But you raise a good point. So on Swiss franc, so I mean look at these two charts. So at the bottom,
Do you think
if
it
you're
has to do with
short,
liquidity to a degree in terms of the Swiss position versus the Euro position?
potentially that's a good point. But like to me, the crowded short franc position, I don't know if it makes less sense, but like look at the chart on the bottom. If you're short, it's hasn't paid you in months, but you've stayed short. And so yeah, it's an interesting development. And the current position is sort of a residual of that like monster move that was in April and May. And if you were to, make 2-3 month highs, you could get just as I talked about, that it happened in the euro that, positioning unwind, this big sort of multi-week protracted, steady sort of covering of a crowded position. You could see that zooming forward in the frame.
Yeah, that makes sense. And it's definitely something to keep an eye on. I guess the last thing I'll get you out on, you kind of gave a sneak peek at September seasonality, and the one
Yeah.
thing that I saw from that is, soybeans have been under significant pressure year to date, underperforming, and it doesn't look like based on seasonality, September is going to be any kinder.
No, no, that's a pretty substantial average, negative monthly performance in soybeans. And yeah, it's one of those things like seasonality to me. There are some traders out there who read a lot into seasonality, and I'm not going to knock them. Everybody's got their own strategy. For me, it's always been this marginal thing. And like basically, it's never a trade initiator. It's never the core of a thesis. But if I've developed a thesis, and let's say right now, let's say I had a technical signal to go long the 30-year bond, I would look at current seasonality as, corroborating that, because the bonds typically, it's not unique to the bond. All these risk-off assets typically rip in late August, early September, because typically that's when the stock market's been volatile. But seasonality to me, it's sort of like this sort of late stage thing that maybe just modifies your position size slightly, but it never forces me like in or out of a trade.
All right. Well, as always, amazing work. Love hearing all this interesting stuff. Keep us updated in the chat as well. But look forward to hearing next week. We'll get more of a look at September seasonality as well. Thanks a lot for joining us, Adam.
Yeah, as always, I enjoy it.
All
See ya.
right. Talk to you later.